welcome back to the channel. This is Investing Tips 101 for beginners. So I mentioned a lot about investing back then, and now this one's catered towards people who are currently getting started. So basically they graduate high school, they're getting a job, and now maybe it's time for them to begin working, or in college, you have money saved up and you want to invest. So looking on my data for my videos, most people are already not new to this already. So if you're not new to this, you can just listen to this video as background noise. But most of the things are basic, and I'm pretty sure most people should understand by now how to do basic investing. So let's get into it. Have you ever found yourself intrigued by the idea of investing but unsure where to start? Perhaps you have felt overwhelmed by the information or the fear of making costly mistakes. The world of investing can appear complex and intimidating, but it doesn't really have to be, as I mentioned before. Consider this. Many people hesitate to invest because they're concerned about the potential financial losses. They worry about not having enough control over investments or making poor choices. But there is a way to navigate these challenges and embark on a journey to financial growth. Basically, if you look at it this way, investing, there's always a risk and reward. And the real question is, how do you stomach this risk and how you mitigate risk? That's the most important part. Now, if you look at it that way, imagine a future where you have more control over your financial choices, where the fear of investing is replaced by confidence, and where you can achieve your financial goals more effectively. That future is possible with the right investment tips and strategies. So as a disclaimer, when you do investments, make sure to speak with a financial advisor. I'm just a guy on YouTube, and you should always speak with another financial advisor. And when they give you ideas, you take those ideas and you see if it's applicable to you. I have to do this as a disclaimer because it is YouTube, and I'm pretty sure people understand the reason. Now let's look into some tips and strategies that I can suggest you to start off with. So first, you want to look at number one. You want to start with the basics. So the basics is, to simply put it, is investing is about putting your money to work to earn more money over time. That's the gist of it, is to fight against inflation. It is a way to potentially grow your wealth and achieve financial goals. For example, if you wanted a house in the future, you ever thought about working a job that only makes $35 an hour? Would that achieve that goal if you're living in California? Answer that. Then next, for example, deciding to invest $1,000 in a stock or in a mutual fund, understanding that by investing in a diversified portfolio of stocks, you will have the potential to earn more income over time compared to keeping your money in a regular savings account. So a lot of people take their money, put in a savings account, and you don't earn jack. Basically, if you look at the money that comes back yearly, the interest they pay you, it's not enough to survive. Stocks, on the other hand, has to potentially grow and match inflation. In this case, it'll grow between 4 to 10%, depending on the stock. First, you gotta look at number two. Number two is to diversify your portfolio. Meaning is, you should consider that your investments as a basket of eggs. You wouldn't want to place all your eggs in one basket. Diversification entails distributing your investments across various assets such as stocks, bonds, and real estate to minimize risk. This approach disperses your investment risk among different assets or asset classes. So to put in more simpler terms is, if you had a basket of eggs, if you put it all in one basket, you drop that basket, all those eggs break, then you're in trouble. But you have multiple baskets designed differently for each. Maybe one basket fails, all the eggs break, and maybe you drop the other basket. If you drop the other basket, there's a really good chance it might not break because you took precautions into it. So when you concentrate your investments in a single asset, such as an individual stock or a specific industry, your entire portfolio becomes successful to that asset's performance. So for example, AMC. Another example is GameStop. And a perfect example is people throwing your money into Dogecoin and Bitcoin. If it performs poorly, which in that case it has for these past couple of years, you could potentially incur substantial losses. Diversification serves as a risk mitigating strategy because different assets tend to respond differently to diverse economic conditions and events. As I made in previous videos, that every economic downturn is about every 10 years. So we look at back at 2008 and now you look at in 2020. Of course, there are other ones that appear, which is a lot smaller, not in grand scale as the pandemic and the housing crisis. Now you gotta look at number 3. Number 3, you want to set clear goals for your investments. So first, you gotta define what are your financial goals. Are you investing for retirement, a home purchase, or your child's education? For example, the 529 plan or Biden's pausing the student loans, as I mentioned back then, those are perfect examples where you want to do with your money from there. Then having clear objectives will help you make informed decisions on whether or not you want to do with your money. I'm pretty sure most people watching my channel, which you guys should click the subscribe button down below, want to take the investments and have that money grow so you don't have to work, mainly looking for financial freedom. Now, which breaks us down to number 4. Number 4 is understanding risk tolerance, meaning is how many times do you look at your stock in a day? Do you get nervous? You can't sleep? Do you have insomnia after looking to your stock? Now, first, consider your comfort level with risk. Are you conservative, moderate, or aggressive in your approach in investing? Your risk tolerance should be aligned with your goals and with your timeline that you expect. Now, breaking down to number 5. Number 5 is when you start investing, you should always start small. And the reason why you should start small, you don't need a fortune to begin investing. Many online platforms allow you to start with minimum amounts. It's about getting started and gradually increasing your investments until you become more comfortable. So meaning is investment into really cheap index funds. Maybe buy into a stock you really like, save up a little money, buy into that stock and just watch it change over time. And of course, bringing back to the previous idea is mitigating risk, and with the risk tolerance, you gotta understand the economy goes up and down. Now, the best way to put it is if you look at gas prices from back then until now. So if you were born around the millennial generation, 1990s, 1995 to 2000, you look at gas prices back then and look at it now. Prices have changed, and it's gonna continue to change, which brings us down to number 6. Number 6, you should always stay informed. Why you should stay informed? Is because keep up with your financial news and market trends. The world of investing is constantly evolving, and being informed will help you make timely decisions. For example, is if you are a day trader, maybe you are a swing trader or you look at trends, there are times when, for example, like Elon Musk makes a really interesting tweet, maybe it could be smart or really idiotic, it tends to change the price of the stock for a few days or within that hours. It really depends. Investing in an asset that you don't understand is one of the most severe mistakes. You can carry the risk you are unaware of, and in many cases, losses that could occur. Meaning is, if you invest in a stock, you should look at their financial statements. When you look at financial statements, you can tell that company is profitable or not. And you gotta understand, even if profitable or not, you gotta understand what are they trying to achieve in the future, and how are they gonna get that money? Are they get their money from selling their products and services? Or are they gonna get that money from government grants? Maybe something coming in the future like AI. The list goes on. Now it just brings down to the last one. The last one is the most important one. I think most people, this is where they mess up, is be patient, which is number 7. Now, being patient is the most important part because the theory behind buy and hold still stays true into today. Because if you look at history back then on how much stocks were worth, all the way back then until now, it has continuously grown. There are downs and turns every year, but when it recovers, it jumps back higher than before. As I mentioned in previous videos, right now, right before the last interest raise, this is got to be basically the final time. You guys can make your choice whether or not you can buy into the stock market and just live a frugal life for maybe a year or two, and you basically reap the rewards of success within like 2025, 2026, when they drop interest rates slowly throughout the next 2024 and 2025. So investing is a long-term game. Don't expect instant results. Stay patient and disciplined, and you'll likely see your investments grow over time. Controlling your emotions in investing is about making decisions based on rational analysis, a well-defined investment plan, and a long-term perspective rather than reacting emotionally to short-term market fluctuations or external influences. This involves discipline, self-awareness, and ability to stay focused on your financial objectives, even in the face of emotional challenges. Now, this is very important because emotional challenges, if you buy into a stock, like let's say AMC, you're expecting it to go up. You buy in at like $76 or $70 and it suddenly tanked. Now, it's been like over a year already since it tanked already. And who knows, if you sell it, you're definitely gonna take a loss. Now, if you don't sell it, there is a chance. Now, whether it go up or not, that will really depend on the company. And another emotional aspect is don't never put all your eggs in one basket. That's the perfect example. Like a lot of people bought a lot of Google and Apple stocks. Yes, you made money back then, or you bought a bunch of Tesla stocks. You made money back then. It might not always apply for the future. What happens? You need money for that instance. Like you need an emergency fund. That means you have to sell your stocks, and sometimes you might sell on a loss. So these are the 7 basic tips for investing 101. I hope you guys enjoy, and make sure to click the subscribe button down below. And I also upload between 2 to 3 times a week, every Monday, Wednesday, or Friday. So depending on the video topics, you guys should comment down below if there's something you guys are looking for, something more specific, revolves on taxes, investing, any financial news you want me to cover, maybe financial letters, or what I think on certain topics. Make sure to click subscribe and a like button, and I'll see you guys next time.